Everybody, happy Tuesday. Hope you're doing well. So, you know, a couple of things here. I've been getting a lot of good comments, both via email and also on the channel in YouTube. And from time to time, I'll get emails about coaching and this and that. And I gotta admit, I'm like the world's worst marketer. I just figure like I want to help people for free as much as I possibly can because when I was starting out, there was no one really to help me. And it's not like I'm bitter about it because I've become very successful. And those episodes really shaped who I was. Like I really had to figure it out for myself. And to me, I think I'm better for it. But from time to time, I can do some coaching. I do some one-on-one consulting. And lucky for me, I treat myself every year. I basically take the entire month of December off. I don't trade. I don't do anything. I go inward. I kind of recollect. I do a lot of planning. I do postmortems on everything in my life, and I just figure, life is short. We don't have enough time to spend with the people that we love and we care about. And so I make a conscious effort to say, what the hell am I pursuing all this money and this financial abundance for if I don't go travel, if I don't spend any time, go to lunch with a good friend? Like there's a point where the money doesn't matter anymore because I'll never have to use most of the money that I have. So, but what it does mean is that for some of you who have written in about, not necessarily doing one-on-one, but doing like a group coaching thing, which is a premium service, I will be putting together a group. If you're interested, you can reach out via email. It's the best way to do it because by the time I see the comments here, which I do read, the group could be filled up because I limit it to just a handful of people because I want to do it personalized. It's easier to do. Could easily do something for 50 people. But I'll never know you if there's 50 people, right? That's a money grab. So I don't need that bullshit in my life right now. So if you're interested in group coaching where I'm actually running the stuff and you have some peers, probably, who knows, 8 people or something like that, we'll end it, we'll keep it there, cap it, reach out. I know some of you have already emailed me. And so I kind of start your emails coming in, so I will, respond to you that way. So the other thing I want to talk about today is like some of the misnomers or the misconceptions, I guess is a better word, in the marketplace. And there's 2. One is on indicators. When you have a small account and you're underfunded, you're looking for a sense of security in a world where the outcomes are not predictable. Right? We have to get comfortable learning we might know our entry criteria, right? Which is another discipline into itself. There's really no reason to put on a trade. 1, if you don't have a trading edge that's definable. 2, if your exact entry criteria aren't met, there's no reason to put on a trade. And when you look at that, you want to develop the discipline of a pro trader who says, I'm going to do one of 2 things every day to exact the most amount of money I possibly can out of the market for the risk that I'm willing to take. And that is, we talked about it yesterday, I'm going to let my winners run. There's not a day trader in Market Wizards, right? When I read that first book, they're all taking positions home. Some of them taking damn big positions, like the Commodities Corporation guys. They put their whole account in one name or one futures contract. So I'm going to let my winners run. That's rule number 1. Rule number 2 is if my setup isn't there exactly the way I need it to be, there's no trade. I'm going to sit on my hands as well. And that becomes a super, super important sense of discipline, is that tomorrow's another day. And I think the short-term traders who have underfunded accounts could increase their level of success gigantically if they focus on higher time frames, they hold on to their winners longer, and they don't feel like because they didn't trade that they're not doing winning behavior. Winning behavior is saying, if I don't have a trade signal, then there's no trade. And to the point where you're like, well, I trade nothing but the NQ and the ES, and I've got all these different setups. I think in that respect, and I know there's teachers out there who want to show you like, the 24 hours of how you can trade, but in my opinion, your trading edge is going to come not from having 17 strategies, but one that you can nail. That's my take. People may disagree. But if you're not focused on being able to own emotionally and financially at least one setup when you're starting, it's the equivalent, and I've heard it said this way, of laying a brick to 100 different houses one by one and expecting that one day everything's going to show up and look like a mansion. And I just don't think the world works that way. You don't get, rewarded in this business by doing, you know, being all over the place. You get rewarded typically by having one aspect that you can do and execute that, in a very specific and certain way. And that is your alpha. That's what you bring to the table. So I think focusing on one particular thing and then saying, well, if this one particular setup doesn't work, because then what do you have? To me, if you try to trade multiple strategies, it's really showing me FOMO. Now, how would you go to school on yourself? Because again, the channels where I try to do all the free stuff, go look at your trading results by instrument, and then inside that instrument, break down the trades that you were executing on what you thought the strategy was, and then figure out what not only the expected value would be for, say, trading the E-mini or the NQ, but go and look and see what's the expected value of that particular setup. Because to me, it's a lot easier to succeed by having one risk unit, one R, one bet size, if you will, trading one strategy and owning it, rather than trying to say, well, I have, again, don't start with me on conviction. What a bunt. That's got to be that word, conviction, and also value, right? Value. Something gets cheaper, there's more value. That ain't the case. The other thing is, don't look at the indicators that you think you're looking at really have very little value. They are, I call them in the book, emotional band-aids, because they only really take price and volume, which you can kind of see for yourself by looking at the price and the volume. And so, again, if you're looking to your left and you can see clear blue sky, not a bunch of structure, you know that the new highs that you think that the thing is making aren't really new highs, and there's nothing statistically significant about that price movement. I don't care about intraday highs. It says nothing for me. I care about things that are much more material that people can't explain through fundamental analysis. Why are the prices high and this thing's not in the newspaper? Why is why are people feeling bearish and hesitant about the market given the things that are going on in the world, but certain names are still making 52-week highs? So you can kind of be your own best coach. And yes, if in the beginning, if you need something like to help validate what you're doing, the indicators can confirm something that you would already know. But the indicator itself doesn't give you a trade signal, right? There are certain measurements too. I wouldn't call them indicators. Like, again, if you looked at relative strength for stocks is valuable, or it has value. And then if you need, because of the way we trade futures, the standardized sizes of all the futures contracts are largely different, right? Except for maybe the grains. They're volume-based, 5,000 bushels, corn, wheat, and soybeans. But, how do you know how much beans to trade versus how much cocoa? So you kind of have to normalize the risk and figure out how many contracts go into your risk unit. Helpful measurement could be picking, whether you use standard deviation or, a 10-period measurement of the average true range, because that's objective, right? And then you could multiply that through the contract size to figure out what the dollar vol is, and then divide the dollar vol into what your R, risk unit is on a dollar basis. And then you could kind of see, right? So this helps things stay objective. You should have one position size, because when you're newer, I just think it creates more self-doubt and more insecurity, and you want to get to a spot where you're thinking of taking $500 to $1,000 out of a trade. When you're newer, taking bigger money trades, growing your money faster, rather than nickel and diming it, because if you nickel and dime it, you're going to be doing it forever. and really focus on the things that matter to help you grow your account as fast as possible. Again, that's going to come from more emotional growth, I think, before you get the financial growth. That's why I've said I may not have explained it so great that it really doesn't matter what you know until you know who you are as a person. How did I say it? If you don't know who you are, it doesn't matter what you know. It's probably true in life, right? It's not just for trading. But this is a very unique profession where emotional intelligence and psychology is enormous part of it. If you go to a job where you have to be an engineer and you make blueprints and you have to learn how to code or you have to practice the law, a lot of that stuff is black and white, and it's a function of you putting in your time and getting it done, right? Presumably you like doing it, you're a pleasure seeker, this and that. But when you manage risk for a living and you're deliberately putting yourself in harm's way, it goes against all the primal instincts that we have, because usually we're born with some type of fight or flight mechanism. So this is a very interesting career where you're putting yourself deliberately in harm's way, saying, okay, I'm going to turn the thermostat a certain level where I know I can take the heat. And then once it gets to a certain point, I know I'm out. I'm going to decrease my exposure, right? Because I know I have to have the risk on in order to make the money. So those indicators really aren't part of that thermostat. That thermostat part comes from you. It comes from inside your body. So what I'm saying is, don't become too reliant on indicators, because the majority of them are going to disappoint you. And learn what they can tell you after the fact, meaning they're not going to really help you ahead of time. I don't have the studies handy right now, but I've read enough of them over time where pretty much each and every one of them gets debunked, right? Nothing is perfect. And so I made it a point to not rely on those things, because there was a higher incidence of them not being reliable. And so what is reliability? Like, how do you have a scale of reliability? Your person's either reliable or they're not. So then why would I want to use a trading indicator that had some varying degree of reliability? Because then now what am I doing? I'm coping again. And now I have to play judge and jury in my brain and kind of talk myself into it, or do I talk myself out of it? Do you see what I'm saying? And so I didn't want to have that ambiguity. I didn't want those gray areas. I needed things to be black and white in order for me to know how to put on risk, especially when I started taking risk home overnight, because I kind of had to. So at any rate, this is a great question. I appreciate, everyone trying to learn this stuff. But in my opinion, you should focus on your self-knowledge first, because the trading tactics and things that you need are actually the easiest part. When you know who you are and how you're made and what makes you tick, emotionally, spiritually, psychologically, then finding the right trading strategy is a lot easier. Everyone does it backwards. You're like, let me learn something intellectually, and then let me look at these funding accounts and see if I can fit into their model. To me, that's trying to put your square into their circle. The better thing to do is to find your trading style and then seek out the right environment within which you can execute and thrive. And then if you do have an underfunded account, do everything that you can to boost it up, as opposed to try to develop bad habits by going through one of these funding places. Because again, at least for me, and I told you yesterday, there's no way I would be able to pass given the parameters that they've set up. And that I have to put on 10 trades because they don't want you to be lucky. Well, fuck, I'll take luck now. Are you kidding me? Why wouldn't I? And what do they care? You're paying the fee. It doesn't make any sense. It's a bad deal. I think it looks attractive, but I think at the end of the day, it's a bad deal. And it works a little bit like a lottery. The winners are getting paid out of the people who can't abide by the rules, or who can't thrive in the existing parameters, right? They're not actually putting on trades. So they're paying. It's not a Ponzi scheme, right? Because you do have to perform. But anyway, I'm getting off subject here. The key is look for price, look for new highs if you're buying long, and look for weakness in the markets. Be careful of divergences, especially if you're looking at intraday divergences, because that data is really random. And it gets you into thinking, To me, it gets you into thinking small, and it's hard to dig out if you want to be a bigger trader and grow your account. Just my 2 cents. Obviously, there are people who have discords where people are hanging on every last word they're saying and they're paying it. I think that's desperation, in my opinion, but it's your money. But as I said before, I'm objective to know that this was my experience. I'm only speaking from my literal after the fact experience. I can't go back in time and say, what would you do today if you had these discords and these chat groups and these private Twitter feeds, and go back to look at in the late 80s and early 90s when there wasn't decimalization, commissions were hard, high. I can't go back and compare that. It's 35 years ago. So all I can give you is my interpretation of what I see now, and conjugate that with the behavior that I needed to execute to succeed, because the behavior is what's compelling. There's always going to be distractions and people looking to get you to sign up for stuff. It's the way the world works. So at any rate, thanks very much for being here. These are really great questions. And I'll be here tomorrow with Ganja, and then I'll see you again Thursday and Friday. And don't forget, if you want to do some kind of live group training, reach out via email through the website, and if there's open spots, I'll put you on the list. Take care. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.